global markets find some rare stability after Donald Trump's partial and temporary pivot on computer and phone imports. China's exporters are already stopping shipments anyway. Singapore eases monetary policy, and New Zealand's economic recovery appears to stall. That's coming up in our 5 Things in 5 Minutes on Tuesday, April the 15th. And then in the first part of a bonus deep dive interview with ANZ senior rate strategist Jax Chambers, he talks about the US dollar's reserve currency status, its so-called exorbitant privilege.
The privilege essentially means that the US government can issue more debt, run larger budget deficits, and also have the US economy can run a large current account deficit. So it's borrowing from the rest of the world to fund its consumption. It can do that without having the implications that other markets would see.
But first, in 5 and 5 with ANZ, for the first time in weeks, stocks, bonds and currency markets were relatively stable and positive overnight in the wake of Donald Trump's apparent tariff concessions on computer and phone imports from China, although tariff policy remains shot through with uncertainty and is far from settled. The S&P 500 was up 0.8% at 4 a.m. Sydney-Melbourne time, and the US 10-year yield was down 11 basis points at 4.38%. Remember, yields move in the opposite direction to prices for bonds. ANZ Group Chief Economist Richard Yetzinger says at some point markets will start ignoring all the back and forth on tariffs and just start looking at the results in the economic data.
And I just wonder, as the data starts to come out in the US, which shows these impacts, does the table tennis with the tariff ball between the US and other economies start to lose that day-to-day relevance? And what becomes actually more important is there just are tariffs and the economy is going to be weaker because of them.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.4%, the Aussie dollar was up 0.6% at 63.25 US cents, and the Kiwi was up 0.9% at 58.79 US cents. Gold was down 0.5% at $3,228 an ounce, and West Texas Intermediate futures were down 0.3% at $61.32 US a barrel. Number 2. ANZ's head of FX strategy, Marja Ben-Zaman, says there's been a range of usual correlations between asset prices that have broken amid all the tariffs drama.
It's not common to see bond prices or treasury yields move higher at a time when dollar moves lower. So it's not the first time we're seeing this. We have seen this in different episodes as well over different periods of time, but it's usually not lasting. What this reflects is that there is just a little bit of loss of confidence broadly in all US assets on the back of developments happening on the trade front.
Number 3. China's exports rose 12.4% in March as exporters raced to get their goods over the border before Donald Trump's tariffs, while imports fell 4.3%, largely due to lower oil prices. ANZ China economist Vicky Xiaozhou says April figures will start to reflect the effects of the tariff shock.
On the ground, we've heard from a lot of exporters they are stopping the shipment to the US. And then I guess the number varies from the numbers from different exporters, but definitely more than 100% tariff will stop any meaningful trades between China and the US. This is undoubted.
Number 4. The Monetary Authority of Singapore eased policy yesterday, although not quite as aggressively as expected, given the central bank downgraded its growth and inflation forecasts substantially. ANZ's head of Asia Research, Koon Goh, expects the MAS to have to ease again by the middle of the year.
While they are still seeing downside growth risk at this stage, it appears that the MAS is not overly concerned in wanting to push through a large easing at this stage. However, we feel that if the growth outlook were to deteriorate on the back of the ongoing tariff uncertainty, then the MAS could well move towards neutral at their next policy meeting in July.
Number 5. In New Zealand, there's been 2 soft surveys in recent days suggesting the economic recovery is stalling. The Business NZ BNZ survey of manufacturers out on Friday showed expansion in March, but at a slower rate than in February, while the Services survey out yesterday showed a contraction, albeit stable from February. Here's ANZ economist Henry Russell.
Now, this far into the economic recovery, we would have expected to see both of those indexes firmly in expansionary territory, owing to the fact that that would signal growth, although that it is coming off a very weak base. Taken together, those two do suggest that the recovery may be losing some steam, and that will be very important for the Reserve Bank in their assessment of whether there is a need to take the OCR into stimulatory territory.
Henry Russell there. Now, in the first part of a bonus deep dive interview on the US dollar's reserve currency status, ANZ's senior rate strategist Jack Chambers explains just how unusual the moves in US Treasuries were last week and why it's forcing some to ask some uncomfortable questions.
Markets were pricing in more easing from the Fed in response to the tariff shock. Simultaneously, though, most days last week, yields on 10-year treasuries were rising. So we essentially had the front end and long end were going in different directions. What was driving that was probably a combination of some sort of markets microstructure things, unwinds of existing trades, leverage trades, which became a bit more untenable given the volatility in markets. The other speculation is that there's this repricing of US assets going on, where for a long time, US assets, whether that's treasuries, the US dollar, or US equities, have benefited from the US is central to the global economy. There's some risk or some concern that last week's price action signify not the end of that, but maybe a reduction in exactly how central the US is as people look for alternatives, given the policy uncertainty we've had.
For those people who haven't been a massive follower of economic history and Bretton Woods and Nixon and all of that, why is the US dollar seen as the most valuable, tradable, reservable currency in the world?
It's a combination of the US has had, I guess, the most economic and political influence in the world for a long time. Things like oil prices are denominated in US dollars. US dollars are ultimately the ultimate or the main currency through which most transactions globally go through. So it ends up being that regardless if you're paying cross borders or throughout the world, typically there will be a US dollar part of that transaction. And that's just a bit of history and kind of the follow through from the 21st century. The last time we had a change in that, the last time we had a change in the reserve currency, like the main currency underlying transactions, was probably around the middle or the inter-World War period, where there was essentially a switch from pound sterling into US dollars as the reserve currency. These things don't happen very often. And it's probably, we're not experiencing that right now. The US dollar remains the reserve currency and probably will for the time being. But at the margins, it's reasonable to think that maybe other currencies, particularly the euro, might become a little bit more central, and some investors will skew a bit more of their reserve allocations for central banks, for instance, into euros and away from US dollars in the coming years. It's not an instantaneous thing. It takes time, but we think marginally that will happen over time.
And it's often described as the exorbitant privilege. What does it mean for the United States? What are the benefits it gets from that?
Yeah, one of the principal ones is the privilege essentially means that the US government can issue more debt, run larger budget deficits, and also have the US economy can run a larger current account deficit. So it's borrowing from the rest of the world to fund its consumption. It can do that without having the implications that other markets would see. What are those implications? It's kind of twofold. One is higher interest rates. Usually if you have a big public deficit, so budget deficit, or you combine that with a larger current account deficit reliant on offshore capital to fund consumption, and a country has to pay for that in one of two ways or a combination of them: a cheaper currency or higher interest rates. The US has been able to avoid that because it provides the ultimate safe asset to the world, US treasuries, which kind of underlie the pricing of most other assets in the world. That hasn't broken down, but we saw a bit of a shift away from it last week. The US dollar cheapened and treasuries underperformed on a cross-market basis. Their yield increased relative to other markets. Their price fell relative to other markets. Perhaps the most striking way was last week saw a completely aberrant by historical standards move where 10-year treasuries cheapened a long way versus Bunds, German sovereign debt. At the same time, the euro appreciated in FX to a greater magnitude. That divergence, that correlation completely broke down, which is probably a sign of a shift in some financial flows out of the US and into Europe.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, April the 15th. Catch you tomorrow with part 2 of our deep dive interview with Jack on just how important the US dollar and its special relationship with the Australian dollar is to Australia's pension funds, which are now collectively the third largest private savings pool in the world. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.